Hey everybody, how are we doing? Happy New Year from ITPM to all our alumni. Welcome back. It's 2021. What a year last year was. Wow. Okay, guys, you've got the Q&A area in the corner. Let me know that you can hear us okay. Some familiar names, like to see. Okay, superb. Right, guys, we've obviously got Anthony on today. We've got a very interesting webinar for you. I'm just going to share my screen quickly before Anthony jumps in and just give you a few updates on what's going on at ITPM. So before we start the webinar, usual webinar rules and housekeeping. If you're having connection issues, vast majority of the time, it's a problem on your side. Just hit refresh on your page, F5, whatever you have to do before spamming the Q&A area. It's very, very rarely our problem. Obviously, all content owned by ITPM. It's our copyright and IP. Questions throughout the day, you can ask in the corner. Absolutely fine to ask questions there. I'll be answering most of them myself while Anthony presents today. So just make sure that your questions are on the topic of the presentation. We're not going to be answering random questions about stuff that's got nothing to do with what we're here to discuss today. Nugget hunter questions, bottom feeder questions, you should know what the definition of those are. We're not going to be answering those questions. And if you ask the same question over and over again and we're not answering it, there's probably a very good reason why we're not answering it. It's probably a nugget hunter or bottom feeder question, or it's got nothing to do with what we're here to discuss today. Okay, with that, guys, I'm going to hand over to Anthony Isa, the godfather of trade ideas at ITPM. And Anthony's going to discuss financial statements analysis from a trader's perspective. Take it away, Anthony.
Thank you, Anton. Okay, just let me share my screen here. Okay, so as Anton mentioned, please put your questions in as I'm speaking. He'll do his best to answer the good ones. We've got a lot of people online here, so if you don't get answered, it may be just reflective of the quality of the question, or it could get lost in the noise. So if you think it's a good one, put it again later. We'll try and get through all of them. Okay, a little bit about myself. Like all the Institute mentors, 20 years in markets experience, starting as options trader at Ord Minnett, JP Morgan here in Melbourne. Spent most of my career in Singapore at UBS, JP Morgan, and Tantalon Capital Advisors. At one point in time, it was the largest long-short hedge fund in Asia. Worked in hedge fund advisory, which is essentially just doing exactly what we're doing here in our mentoring programs, helping hedge funds with their idea generation, their trade structuring, their risk management, portfolio structuring. And through that period of time, running lots of internal portfolios at UBS and consistently ranking in the top quartile across the board. So let's get into financial statements for traders. So we've got a whole range of alumni here and people signing up and being involved in the education process at ITPM. Some have understanding of financial accounts, some don't. We're going to keep this pretty broad and general with a few specifics, not too much, not too heavy on the maths. Hopefully it'll be not too boring. Obviously the financial statement part can get a little bit dry. We'll try and keep it interesting for you today. So the most important thing really is that financial statements can be broken down into ratios. And what we're trying to do is we're trying to measure the quality of the company's financial situation, which is therefore, we can call it our qualitative assessment. Now, some of these things are important to us as traders and some of things are not. You know, accountants, analysts might look at other components of balance sheets and ratios, profit and loss statements. We want to try and focus on certain ones that are more relevant to what we're doing. We're not deep value investors. We're not Warren Buffett. We're traders here. So we're going to focus on those specific ones. And don't expect, whether at this point in time or even in the future, you're not going to be a forensic accountant. You're not going to find some fraud or spot some numbers that no one else has noticed. Analysts will be trawling over these in a way that we won't be able to. But they'll be taking those numbers and looking at different ratios, not looking at them from a trading perspective. So when analysing financial statements, what we're really trying to do here is trying to put some meat on the bones of our potential stock ideas through this qualitative process. So you're all alumni. The 30-second recap of what you already understand through the ITPM education is we start with our worldview. So your worldview is complete. You've gone and found some sectors that you like. We've looked at the quantitative measures, some of these market ratios, to do a quick selection of the stocks that we want to do a deeper dive on. Now, I'm going to use the example for most of this session today being Site 1, landscape supply. For those that have watched What's on Your Mind in the past, you might realise that I spoke about this one late last year. And this is a live, real version process that I went through with this company, with a mentee who, we went through the entire process, and it's a good, simple one, perfect to use as an example here. So you can see here, it's trading at a big premium to the rest of the universe that I've gathered for it. Now, this came out of economic data and retail sales data, in fact, and it's not a big universe. It doesn't have many comparative companies at all. So I built sort of the best universe that I could. So some lumber names, some retail hardware names, so that you would recognize Home Depot and Lowe's. And Site stands out as being the big premium on the PE side of things. So you want to sort of investigate why. Do these headline numbers stack up? So let's look at the qualitative analysis. Let's look at the financials and see what we can find. Before we get into it though, a couple of caveats. The most important thing is when we're marrying up trading and accounting, we've got to remember that the accounting side of things, the financial statements, are backward looking. They're fixed point in time. So even if a quarterly result came out today, it's reflective of the result of the quarterly numbers they put together a month and a half ago, and reflective from the period of time before that. Whereas on the trading side of things, we're looking at what's happening in this next 1 to 3 months. So we need to marry those up and realize that these numbers can change in the future. And that's part of our process, trying to work out how they change. Are they changing for the better or for worse? So when we're analyzing these statements, we're information gatherers. We're trying to get a better understanding of what's driven revenue earnings in the past, what their comparison with their peers looks like. They'll be trading at a premium or a discount to the sector, relative valuations. Is this supported by the past information? And then when we look into the future, we look at the company, we look at the market consensus numbers as well, we look at the KPIs, and does that justify the premium or the discount, if we're looking at a short idea, that it might be trading at. It's also important to note that a stock is not a long or short trade idea based on our quick quantitative valuation, our qualitative valuation, looking at these financial statements alone. We still need to look at forward-looking projections for the company. We still need to do a deeper dive into what is driving those earnings and earnings growth, obviously, if it's a buy. And then we need to find 1 to 3 month catalysts. We need trade structuring. And then maybe we've got a trade idea. So we're going to focus on the first part of that being the qualitative process. The second caveat is there's no handbook, there's no rule books, and there's no hacks. And if there's one thing that you would have learned through the Institute's education and watching the online series with Anton, is that there's no quick fix. There's no little check the box, move on, check the box, check the box. Oh, I've got a box checking thing and it's all done. That's not how it works. It doesn't work that way in trading now, and it never has. So what we've got is a flexible and dynamic structure and process that's forward-looking and does change. It changes from company to company, it changes from sector to sector, and it will change a little bit during different times of the market as well. So it's not the right approach just to say, okay, well, here's my big checklist, and once I've checked that off, I've filtered down my universe from 20,000 stocks, and now I've got 3 or 10 or 2,000 to choose from. We're not doing that. It's not a systematic quantitative process. It's a qualitative process and assessment. So the first part we're going to look at is the classic financial ratios. And these broadly operate across all sectors, regardless of what type of business they're involved in. They apply to mining companies, they apply to software companies, they apply to retail companies, they apply to banks as well. In addition to that, we'll be looking at the idiosyncratic financial ratios. And these ones are unique or specific to certain sectors and don't apply across the board. And I guess the other thing, just to reiterate, and there'll be a few things that I'll talk and repeat myself a little bit, but these are important measures. We are not value investors here. We're not calculating DCFs. We're not looking for undervalued coal mining companies or banking stocks. We're not tweaking weighted average cost of capital based on bond yields and building huge financial models. We're trading here, and it's quite a different skill set. So, as I mentioned, the trader's approach, bottom-up, qualitative, and dynamic framework. The classical assessment, which we'll talk about shortly, it's made up of the capital structure, financial health, financial liquidity, revenue and profitability drivers. The idiosyncratic measures, an assessment is financial measures unique to that sector, and KPIs. We'll talk about those as well. The sector and peer group comparison is taking those and saying, okay, well, how does that compare to the other companies? Is this raw number a good number? How does it stack up on a relative basis? And again, what we're trying to answer here is the premium or discount that these stocks are trading at, is it supported by the evidence that we get through this qualitative assessment? And most importantly, why? What has driven it? So to complete this, we must assess the future expectations of financial statements and expectations as well. And that's beyond the scope of what we're going to talk about today, but is vital to the process. So some of you, most of you will probably know most of these things here, but just a very quick refresh. What are financial statements? 3 major components: balance sheet, income statement, cash flow statement. When you see a 10Q, which is the quarterly report, or a 10K, there will be other segments broken down. When you look at presentations from the companies, they will break down areas of these further as well, particularly the income statement. And what we're trying to do is spot the drivers behind these revenues and earnings. What's important to the company? We're trying to spot trends, and again, trying to work out whether the premium or discount is justified. But just to reiterate again as well, even if we get all that component right and it all stacks up, we still don't have a trade idea at that point in time. We still need catalysts. We still need to work our way through a trade structure and the gatekeeping process to make sure everything is aligned. Okay, so the classical assessment: capital structure, financial health, financial liquidity, profitability drivers. These are all interrelated. There will be components coming out of balance sheet and income statements. So it's an all-encompassing process covering off on each of these, and these tend to stick across all sectors. So hopefully you can see this, but it's not that important. The key thing here really is this is a very simple balance sheet. This is the balance sheet of Site Landscape, and it's very much one of the simpler balance sheets that I've come across for a listed company. It's important to remember as well that these numbers are, again, a fixed point in time. In this case, the first column there is September 27 this year, the year just passed, 2020, and its comparative period is December 29, 2019. Common capital structure measures that we would look at would be return on invested capital, return on assets, return on equity, net debt to equity. And again, it's important to remember we're not value investors. Many of these measures here are probably more important for value investors than they are for us, but they are certainly things that we want to check. So if we look at the structure of a balance sheet, it's very simple. Assets at the top, assets equal liabilities plus equity. And you can see that there, total assets, 1.8 billion and some change. Total liabilities and equities, 1.8 billion right down at the bottom. So let's quickly look at a couple of ratios that we would want to check out for a company when we're doing our qualitative investment. Return on assets. Return on assets is net income divided by the total assets. Now, I've taken net income from the income statement. It's on the next slide. And the total assets that we saw just there, $1.857.2 billion. Simple calculation. Our return on assets is 2.6. As an absolute number, that sort of doesn't mean a great deal to us. We can go and compare it to the sector. We compare it, in this case, to wholesale trade and determine, okay, is this a good number or a bad number or just an average number? And in this case, it's a reasonably average number. It's sort of smack bang in the middle of what we would expect. And the same for the return on equity. Net income divided by equity. Again, we take the equity from that balance sheet page, 777 million. Our net income, 48.2, gives us a return on equity of 6.2. Again, broadly in line with the sector. Nothing outstanding one way or the other. We can do that. We can compare some stocks you'll look at, and there might be 10 identical companies. You could be looking at regional banks. You could be looking at online retailers, although their assets probably pretty small. Bricks and mortar retailers will have a lot more assets, and is probably a better measure. Then you compare across the board and determine which one stands out. This is the income statement that I talked about, and we'll start talking about financial health. Now, with Sight, they provided much better information than a lot of companies do. And you'll find that as you do research, some companies make life very easy for you and some companies make it harder. As a very basic rule of thumb, if they're making it harder for you, there's usually a reason why. It's not black and white, but it always just makes me a little bit more cautious. These guys provide a great deal of information. So here's quarterly numbers running from 2018 through to the recent quarter in September last year. Financial income statement, working from top to bottom. Sales, taking away your cost of goods sold, gives you your gross profit. The next line you would take out, deducting from that gross profit, is your SG&A, your selling and general and administrative expenses. And now we're down to our operating income. You know, how much money does the business make running its operations? It's also basically its EBIT line. It's earnings before the next two lines. One is interest and one is tax. We take away those numbers from our operating income and we get the bottom line. We get our net income, our money after tax that's sitting there available to do something with. In this case, they've provided earnings per share numbers as well, not relevant to what we're trying to do now though. So looking at that financial health and using a couple of key ratios that we would commonly look at, and in this case, we're taking that EBIT number. Now, just to highlight here, the EBIT number that I'm using, because we're comparing a balance sheet item in terms of in net debt to EBITDA, the net debt is an annual number. We're taking it as an annual number. I'm trying to compare apples and apples, and so often these numbers will be done on an annual basis. So in this case, I've taken the last 4 quarters to work it out. So that EBIT number there, $162 million, that is simply that the operating income line for the last 4 quarters added up. I've done the same thing with the interest expense, which is $27 million, which gives us an interest coverage ratio. So the EBIT divided the interest expense of 5.93. The reason why this is important, paying back the bare minimum, so your interest and not the capital, is an important measure to understand the financial health of a company. In this case, 5.93 is a good number. The same thing with looking at the broader debt, so the net debt to EBITDA. We'll talk a little bit later about EBITDA when we get to the cash flow statement, but what EBITDA is simply that EBIT number, so before interest, before tax, and then there's 2 items that will be in income statements and cash flow statements, which is the depreciation and amortization. And these are accounting measures, they're non-cash. And so we want to add them back. When we're trying to work out the financial health of the company, they're not important. They could be changed with the CFO, the accounting department can change the rates of depreciation. It's not a cash item and not reflective of the financial health. So what we do with that, we have our net debt. So we take the debt on our balance sheet here, and if we find the line total long-term debt, which is about 2/3 of the way down the page, $425.7 million. And we deduct from that the cash, which was 274, and we have EBITDA of 238.5. So the ratio of net debt to EBITDA is 0.63. And again, that's a good low number. It suggests that the earnings, the cash earnings of the company relative to the amount of debt that they've got is very sustainable. But it's important to remember that these numbers can change. So what is often more important than the absolute number is the trend. We'll have a look at another example or 2 here. So on these tables here, we're working from right to left. So you can see 2015 for XPO. We'll quickly look at that. You can see that the ratio is actually negative. They had negative EBITDA in 2015. And then we moved to 2016, and that's a big number, 25.46 times. They've got almost $5 billion in debt, $373 million in cash, and EBITDA of 177. 25.46 times is a big, big number. We'd go back here and look at what it was for site. It's 0.63. So we were talking sort of 40 times the number. But the trend is good. Next year, 2017, we're down under 14 times. We're then down under 6. And then in 2019, it's popped back up above 6, 6.72. The trend is very strong, and we can learn something from looking at this and looking at these ratios. We can see that, firstly, the EBITDA has increased dramatically as time's gone by, and the debt levels have largely stayed the same. So the improvements come from not paying down or reducing debt, but from very strong earnings growth in the business. And that's the type of thing that we want to see. And then we can make an assessment. Is that going to continue? As an alternative example, Ford started at 6.25. Again, it's a big number. And wound up in 2019 at 15.49. Driven by 2 things driving this ratio. So we want to look and see what's going on. When we see that ratio and that trend, why is it happening? The EBITDA has more than halved from 18.9 to $8.8 billion. At the same time, the net debt has gone up, 89 to 101. And these are important because, one, it puts the company at financial risk and a limited ability to pay back this debt. And it also reduces flexibility dramatically. If they saw an acquisition they wanted to make, how are they going to do it? Maybe they can do it with equity. Maybe they can go to the bank. Maybe they go to the bond market. But the bond market and the bank are going to say, well, hang on a minute. Your net debt to EBITDA number is 15.5 times. We're not lending you any more money. XPO, on the other hand, if they said, well, we want to expand into Asia Pacific, the banks are more likely to say, well, okay, bond market might say the same thing. Your earnings are growing strongly. You've managed the business well. Your net debt to EBITDA is manageable at this level and getting lower. The trend is something we like. Here's some more money to expand. So that's the ultimate reason why we look at some of these things. Why? What does it tell us? Now, when things are wrong and numbers are high, you can go and check the accounting, check the notes to the accounts. This will be in the 10Q. In the case of debt, there's always details about debt covenants. And these are things that the banks require, the bond markets require in order to maintain your creditworthiness. In this case, this is Live Nation. Live Nation, when I looked at this at the start of last year, their covenants were 5.75 times net debt to EBITDA. Now, to give you an idea, again, comparison, 5.75 times is a big number, but it's not as big as these numbers. So that's an indication of how bad the situation at Ford probably is at the moment. 5.75 times. You look at that and understand what's happening going forward. In this case, they have to maintain that on a quarterly basis, and then it would drop down over time. Now, last year, they had negative EBITDA every quarter for the entire year and had no signs of doing it, a positive EBITDA until COVID's over. So they're in massive breach of their covenants. It reduces their flexibility. They will have readjusted their loans. They've probably tried to raise more money early on. We'll talk about that a bit later, but it puts them in a very, very tough spot. So at the moment, the banks are sitting there, the bondholders are sitting there saying, do what you can. They're forward looking as well, but it's a very, very tough situation. And you'll see these things in the notes. The most important thing really though to think about with debt, because we are time constrained, this only matters when it matters. And it only matters when the cycle is turning and banks are saying, hang on, where's our money? And that is, you'll go 3 or 4 or 5 years without having to really look into the debt levels of companies, because they will be able to go to the bank, their businesses will generally be growing, and they can always refinance and kick the can down the road. When something like COVID happens, a recession, end of cycle, that's when these things particularly matter. So financial liquidity. There's a quote on the screen here. I won't read it out, but it's very eloquent and clearly not written by a hedge fund manager, not really written by an investment banker or a trader. George Bernard Shaw, the Irish playwright, eloquently stated why money is the most important thing in the world. And the essence of what he's saying, and what we're focused on as traders as well, is liquidity is vital. If you can't pay your bills as an individual, as a company, you're getting yourself into real trouble. So there's measures that we want to look at, ratios that we want to look at in the financial statements that will help determine, is there an issue with this company and their ability to pay their bills? So 2 of the key ratios that banks, debt investors and equity investors will look at, and we also look at as traders, are the current ratio and the quick ratio. The current ratio, as the name implies, is the current assets divided by the current liabilities. Quick ratio makes an adjustment to take inventory out of that. So if we look at this here, this is again from that balance sheet that I showed you at the start. Current assets for site, 1.115.6, so a bit over $1 billion in assets, and 406 in liabilities. Gives us a ratio you can see on the right there of 2.75, and that's a pretty comfortable ratio. The quick ratio comes in at 1.58. The reason why we take out inventory in a quick ratio is because if the shit has really hit the fan, if you're depth of COVID, businesses don't know what they're doing, depths of any sort of major recession, and the banks are saying, okay, well, let's just see if you've got enough money to keep paying things back, or you want to make an acquisition because other prices have gone down. What's the assessment of your business? Can you do this? How quickly could you pay things off? Inventory is not necessarily something that you can move quickly. So hence the name, the quick ratio. Let's take out the inventory, and we've got a ratio that better reflects the ability to turn something into cash very, very quickly. And a quick ratio above 1 is fine. And these are quick checks that we would do to look at the financial liquidity of any company. The other key component to financial liquidity is the cash flow statement. And this is the final, this is the next part of financial statements that we're looking at. So we've looked at balance sheet, we've looked at the profit and loss, we're now looking at the cash flow statement. And it is also broken down into 3 parts. And they're quite easy to understand and important to understand what the differences are. The first part is the operating cash flow, and that's simply the inflows and the outflows of the business from revenue generating activities. So it's the sales of the goods, it's the purchase of the raw materials, it's the supply of labor, it's advertising, it's transport costs. It's anything to do with the running of your business in terms of generating revenue. The investing cash flows are more driven towards the balance sheet, what's going on with capital, property, plant and equipment, for example, CapEx. This could be something you buy. You might go and buy a warehouse. You might sell, if you're a mining company, you might have a whole bunch of trucks that you don't need, you would sell those. That would appear in the investing cash flow component of the cash flow statement. And the final part is the financing cash flow segment, which is your loans, your dividends, equity raised or buybacks that are done. This is how you fund your business and manage the capital structure of your balance sheet. So one of the big things that we often see companies talk about is share buybacks. There's 2 ways you can have cash for share buybacks. You can get it through operating cash flow, so money the business has earned, or you could go and borrow money and buy back stock. And that's what lots of companies have been doing for a long time. And it's why they got caught at the start of this year and needed to raise more equity, because they depleted their equity levels buying back stock over the previous 5 to 10 years. So looking a little further into cash flow statements and what we can determine by looking at them, and what's probably the key ratio that we would look at. So the operating cash flow ratio is comparing that operating cash flow number. So in this case, these numbers are the 9 months to September. So we've got on the left-hand side there, you can see down the bottom, net cash provided by operating activities, $180.7 million for site. We then go and look at what their sales are for that period, which was just over $2 billion. And it gives us a 0.1 times ratio, operating cash flow ratio. Again, this is a number we can either compare to the sector, compare to other companies, or compare to the company's history and determine what the trends are and what the relative performance is. And there's a few things just to highlight quickly when we're looking at financial statements like this, beyond some of the ratios, just a few key things to look at. So firstly, bottom right-hand side, you can see the net change in cash. The company has an additional, compared to the previous period, $255 million in cash. Now, we know that $180 million of that has come through operations, through the buying of goods, spending on staff, and selling those goods. They've made $180 million in operating cash flow. What have they done with that money? Well, some of it's obviously sitting on the balance sheet. We look at the investing activities, and there's a really interesting line here, and this is one of the key components that we can then sort of understand a little bit more about site. $73 million they spent on acquisitions. And so when we do a deep dive into how they're doing things, we understand they are buying lots of similar businesses, small businesses, and rolling them up into site. And this is a strategy they've been doing for a long time, and they're likely to do in the future. So that gives us some clues to what we can expect and how we can make an assessment on the future drivers of earnings. We also see financing activities, $161 million, which is quite a big number coming in. And the top line there tells us where most of that happened. They raised stock, raised equity via a placement towards the start of the year, $270 million. You can see they repaid some assets, they increased other assets, so debt. So they've refinanced their debt at some point, probably paid off some of the more expensive ones that were due early, pushed some of them further out, but they've increased their cash by $160 million, and mostly through that equity raising. There's a bunch of things we can learn from that, and the operating cash flow ratio is one of the key ones that we would look at. Looking at Live Nation as a comparison, we can see, now again, the cash flow statements are slightly different, but the headings are all the same. But if we look down the bottom right, third line from the bottom, net increase in cash, $823 million. So you'd think, okay, well, that sounds like it's a pretty good thing. So let's have a look and see where that's come from. Well, firstly, there's no operating cash flow ratio because their operating cash flow was negative $390 million. So that's a real concern. I mean, that's the clearest and most simple example of just why the business is not doing particularly well, or why we might have concerns. They're just not making money. You can see they've made purchases of property, plant and equipment. So investing cash flow, they spent $190 million there. To fund these things, they've got to get money from somewhere. And what they did, they went and borrowed a great deal more money, $1.6 billion proceeds from the debt issuances. They would have done this at a pretty expensive rate. And as we saw earlier on, they are already in breach of their covenants. They're going to need to see very strong earnings growth coming through in the forward-looking periods to be able to pay this back and to have comfort that it's a sustainable business. Now, just to reiterate again, these are historical backward-looking numbers. This is the accounting side. The forward-looking side, which is the trading side, is where we need to make assessments about, are these numbers going to change? Are they going to get better? The market's basically making an assessment at the moment that things are going to get better. Comfort around vaccines, the vaccine timeline, providing comfort that these earnings are going to return. So the share price has been doing a little bit better since that vaccine announcement. If there's hiccups with that, then there may be concerns about the forward-looking part. But these are historical numbers, and the historical numbers are not good, but we need to marry that up with our trading view. The final part of our classical assessment is our profitability drivers. You see here again, profit statement, that net income that we talked about from the earlier examples, 48.2. Our net sales for the quarter, 751. And some of the key things that we look at, and these are probably more important to us as a trader than some of those balance sheet ones that we spoke about. And again, Site provides a lot more information and makes life easier than most other companies do. So they've given us our margins here. So net sales, our gross profit, 250 mil after we take away our cost of goods sold. So our gross profit margin, they've given it to us there, is 33.3 for that September quarter. We then, from that number, go and deduct all our selling and general administration expenses. We have got a little bit of other income that they add in there as well, and we get our operating income, or our EBIT. In this case, operating margins, 9.1%. Okay, so we know where that sits, and that's a number, again, we can compare to other companies, we compare to the past. The net income, again, after we deduct interest and tax, we're down to 48.2, and a net income margin of 6.4. They've given us the previous quarter, comparison period for September last year, and you can see all these numbers are improving. 33 to 33.3, improvement in operating income, and improvement in margins for net income from 5.3 to 6.4. So again, the absolute numbers are important, but the trend of what's going on is more important. The other part that is particularly important at the moment for analyzing financial statements of companies and the financial health of companies is operational leverage. And just to quickly explain what's been going on with any time when you have a recession, whether it's COVID driven or anything else, people realize, individuals do this as well, but obviously we're focusing on corporates, but you'll notice it in your own life most likely as well. When there's concern about where revenue is going, the first thing people do is look at costs. So all these companies will have been looking at costs and trying to work out which ones they can cut, because that revenue outlook is uncertain. As things improve, no one rushes in to put those costs back on. What they tend to realize is, you know what, we can make $1 billion of sales on a 10% less cost base than we had before. And so what you get is margin expansion. And that is really, really important, because through these levels, $1 of sales will flow through more aggressively to that net income line. And so one of the things that I like to do to look at how that flows through is just compare the levels of growth across those lines. So here's the same numbers again, but all we're doing is just comparing that growth level and the operational leverage of the business through from the period in 2019. So the sales growth, the top line growth, always important for companies, particularly companies that don't have earnings. We'll focus on sales growth. In this case, 15.2%. The next line down, the gross income, was actually a little bit better. When you do a little bit of a deep dive and work out why that is, you realize that their transport costs, they got under control. Some of it will have been oil price, there will be other things there, but they reduced their transport costs. And that's how they were able to get stronger growth at the gross income line. Operational income, stronger again. So SG&A, they got those numbers down aggressively. Operating income growth was up 30%. And interest expense, they paid down their debt, they restructured things as well. That allowed them to grow the bottom line even faster. So you can see here, the top line's growing at 15%, the bottom line's growing at 39%. And that provides operational leverage the whole way through the business. We don't really want to, as traders, trying to find a business where to get an extra $1 in sales, they have to go and put an extra 95 cents in costs in. We want extra sales to come through without having to put another sales executive on, without having to get another truck. At some point you will, but we need to see that operational leverage. And this is a key thing that we want to find when we look through financial statements. Okay, so the idiosyncratic assessment. This is the second component after the classic assessments that we've done. And this is specific measures that are unique to a sector, or certainly applied to some sectors and not to others. Like the ones we've just seen, they can be drawn from balance sheet, cash flow statements, profit and loss. There might be other financial measures that they produce as well, which we call KPIs, they're key performance indicators. We can glean these from annual reports and 10Qs, quarterly statements. We can get them from presentations, and we can find out the important ones by looking across industry analysis. And as I said, they usually measure something specific to a sector. So here's a few examples. We won't go into detail on all of these. The combined operating ratio. It's an insurance company measure. It's not used in any other business. Very specific, just to insurance companies. Same store sales, a little bit more general, but clearly very focused to bricks and mortar retail, fast food, anything that has a building that they sell a product out of. Net interest margin, a banking number that is very important in the banking sector, not relevant elsewhere. Average seat kilometers or miles if you're in the US, a key measure of the successful financial performance of an airline. Again, irrelevant to everyone else, but very, very important to airlines. Software companies, SaaS models, annual recurring revenue is vitally important. A number that we would look at for those types of companies, and again, not for too many other sectors. So for site, one of the ones that we would look at would be inventory turnover, which is sales over inventory. So again, going back through those financial statements, we find the sales for the full year, we find the inventory, and we get a ratio of 5.4. We can then go and compare that to its history, we compare it to other stocks, and say, okay, is this a good number or a bad number? Is it getting better? Does it give us an idea about how things may go in the future? So I'll go through a few sectors and just highlight some of these and not work through the process, but just so you understand some of the different ones and some of the things to look for. I won't read all of these out, but many of these will make intuitive sense. Same-store sales for retail. Cash conversion cycle is vitally important. How much cash is tied up in your business trying to generate sales? Your sell-through rates. The last year or so, probably the most important metric for retail businesses is your online percentage of sales. What's been happening with that? Were you able to pivot quickly and boost those? Did you have it underway already? These are key measures that are very specific to retail stores. Customer retention, average sales per customer. There's a whole range of these ratios here that are idiosyncratic, very focused for the retail sector, not relevant to banking stocks or software companies. For insurance companies, again, here's from QBE, this is a operating results. Gross written premium is sales as we know it. And you work through their list. Net claims ratio, commission and expense ratio, and core operating ratio. And this number here, this 95 and 97, this is the core of insurance business. This is basically taking your premium, deducting your payouts, so the premiums that you've paid out, deducting your expense and saying what's left. And this is the core to insurance, and this is the core to how Warren Buffett has built his businesses. Because that number at 95, 97, what does it tell us? It tells us they're only making 3% on their business. But what they do have, in this case, they've got $13 billion of float sitting there. So it's essentially free money. In fact, they're getting paid, the way you can view it, they're getting paid 3% to invest that money. So they go and invest it and get a return on that, and that provides the return. But this is relevant only to insurance companies, but important to insurance companies. If you didn't look at this, you wouldn't be analysing the financial statements of an insurance company properly. Activity ratio for retail. So we've got different ones: asset turnover, inventory turnover. You can see the formulas there. They're all very simple. Just two items from the balance sheet or two items from the balance sheet or from the income statement. Payables turnover, receivables turnover, and then the cash conversion cycle. This is an interesting example I just wanted to use. So the lower the number, the better. This is measuring how long cash is in your business from the time you make a sale, paying everything off. And you can see here for PVH, which is retail company, Tommy Hilfiger, Van Heusen, and a bunch of other big names, but they're the two biggest brands that they have. Previously, as you work through those numbers, accounts receivable, inventory days, and then the payables, gives us a cash conversion cycle of 15.95, which is a good number. Now, last year, as the earnings got hit, the number actually turned out to be negative. In general, you would think this is a really good thing. I mean, if you've got a negative cash conversion cycle, it means your business, you're earning money just with interest in the bank as you're operating that business. But then we look a little closer and we see the biggest thing here is accounts payable has blown out by more than double. And so they're still asking their customers to pay on time, and their customers are paying a little bit later. The terms for their customers, the top line accounts receivable, would be 30 days. So previously everyone was paying just a little more. People are now paying behind. But the biggest thing is these guys have said to all their suppliers, we're not paying. Or more importantly, is it that they can't pay? So that's one of the things that we would look. This ratio would then tell us, okay, I need to look a little bit more deeply at that. What's going on with the business? Is it sustainable, or are they in trouble? For banks, I won't go through all of these, but you can see under these subheadings that I've got here, income statement, balance sheet, valuation, margins, all of these idiosyncratic relative to banks. I put stars there for a couple very key ones: loan to deposit ratios, net interest margin that we mentioned before. They're capital ratios that are focused specifically on banks and less so on, or certainly not on, other sectors. Tier 1 capital, focus on capital ratios that are important. And over on the right-hand side, the quality of their business and the quality of their loans. Non-performing loan ratio is a very key one for that. So again, these are specific for these sectors. We need to look at them all very, very closely. Airlines, as I mentioned, available seat kilometres. I won't go through them all one by one, but these are very specific to airlines. You'll find them in financial statements. They will produce these, and we can compare them to the other companies in the sector. We can compare them to their history and make an assessment on where they might go in the future. In addition, obviously, we're still using those classical assessments, financial assessments that we'd be looking at as well. Then what we've got to do with all of this is tie it back into a sector comparison. And we would do this as we're going along. When those numbers come through and say, okay, well, how does that compare to other stocks in the sector? And most of you will have seen this through the ITPM. This is the top part here is just taken from the US stock screener. And this was our initial comparison where we looked at PEs and earnings growth. Below some other metrics that we could look for, and these are market ratios. So they're taking something from the balance sheet and comparing it to the market price. So we're comparing, the price and the earnings, for example, or the price and the cash flow. So these are market ratios. And in order to do these, we can't just do them with the balance sheet or the profit and loss. We need to know what the share price is as well. And these are very good ratios to compare across sectors. As I said earlier, Site doesn't have the greatest list of competitors. In fact, it doesn't really have too many other listed competitors. So I'll just give you a couple of examples of how we might look at some idiosyncratic measures and compare them as well across sectors. So fast food ratios, very obviously retail driven, same store sales, very, very important. You can see here minus 3.6%. So despite all the growing revenue and system-wide sales that they've got there, increasing cash flow, all the charts are doing exactly what you'd want to see, bottom left to top right. But the same store sales are negative. So that lets us know, okay, well, this growth is coming through other measures. This growth is coming through store rollouts, other ways, which we would argue is probably lesser quality than growing through the same stores. So we can understand that, we can compare that to the rest of the sector. If we look at Domino's, for example, and say, okay, what's going on with their same store sales growth? In the US, they've been averaging 3.8%. Since 2010, it's been 6.9, 36 quarters of same store sales growth. That is operational efficiency. In the international market, they've had 105 consecutive quarters of same store sales growth. That means without having to go and spend capital through the business, buying more stores, expanding, they are able to, through increased volume, in some cases increased prices as well, drive sales through the same store. And that would be a very key measure for retail companies or fast food companies in this case. And that's the ratio that we would look at. We'd find these in the balance sheet. We'd find them in the other financial statements that they produce and say, okay, well, how do they compare? And does that give us comfort or confidence that those are going to increase in the future as well? So to put it all together, our qualitative assessment that we're doing with financial statements is combining all of these things. The classic statements analysis that we looked at the start, the sector comparison we've looked at just then, and then importantly, the idiosyncratic measurements as well. Those KPIs, those sector analysis that we can get from financial statements that are specific to any individual sector. When we're assessing these, we want to ask what, why, and will. What have the numbers done? Have they gotten better? Have they gotten worse? We can look at those trends that we saw with XPO and Ford and realize, okay, well, one's getting better, one's getting worse. We can gather that. Most importantly, we want to go to the next level and say, okay, well, why have they done that? Again, much of that is sort of out of the scope of what we're doing here. We can do a deeper dive still and say, okay, well, why have earnings gone up so much? Why have margins expanded at this level? And then the most important thing, because this is accounting, financial statements, and backward looking, we want to know the forward looking component as traders. Will they continue this way? Not only then we're in a position where we can say, okay, well, yes, I think it is trading at a justifiable premium to the market, and I think it's going to continue. And then at that point, we can start looking and say, okay, well, are there catalysts ahead? What's our gatekeeping process? And what sort of trade structure can I put in place? And having done all of that, we might just have ourselves a good trade idea. So I hope that helps today. I know there's been lots of questions coming through. I'm sure Anton's been answering a lot. I'll jump on there now as well, and we'll start answering a few of the key ones coming through now. So thanks for your time. Shoot the questions in there, and yeah, look forward to talking to you.
Cheers, Anthony. Okay, I've been answering a lot of questions in the corner. Guys, you can ask questions live, obviously on topic to today's presentation, please.